Okay. So welcome everyone to Contrarian Cash Flow. This is actually a little surprise bonus episode we're doing this week because when I wanted to talk about funds, I realized who are my friends that have raised funds in interesting ways and non-traditional ways and for interesting niches. And I had to go to Nate Lustig because I invested in your fund years ago now. And I've also seen the operation firsthand in Latin America, and I wanted to break it down. So first of all, thanks for being with us here today. And where I kind of wanted to start was, why don't you give us first an overall picture? What is Magma Partners today? And what's the landscape so people know and they can read in the segment on cash flow? And then let's get into how you got to where you are today.
Sure. So today, we're on our third venture capital fund. We have about 40 million for this fund. We invest in Latin America, and we invest in anywhere from pre-seed, really early stage companies, all the way to Series A, all across LATAM. And I think we've invested in about 85 companies across pretty much all the LATAM countries.
Yeah, and you're just a good old boy from Wisconsin, right? Originally,
I'm
the
from
major way
Wisconsin.
down south, major way down south. And the way that you started, I loved. I'm going to butcher the story, but such a non-traditional reason to go down south. So why don't you talk to them about, what got you to go south and start a fund?
Yeah, so I started as an entrepreneur. I had two tech companies when I was at school at Wisconsin and ended up selling them both. The second of which is what took me to Chile. And I was in the pilot round of something called Startup Chile, which is a way for the Chilean government to basically jumpstart their tech ecosystem. So they gave us $40,000 of equity-free money plus a visa, office space, contacts. And we were in the pilot round and we were company 5. And because of that, they introduced us to pretty much everyone in the country from universities, family offices, entrepreneurs, VCs, government. They had me give a speech in Spanish to the president when I didn't speak Spanish yet at the Chilean version of the White House. So it was just this great program. And after the program, after 6 months, I decided to go back to the US. We ended up selling our company. And then I wasn't sure what I wanted to do. And I decided to go back to Chile for what I thought was going to be a year to learn the rest of Spanish and also see what I could do with that network. And I worked at a Chilean startup for a little while, and then I got invited to create a class at one of the top Chilean universities called How to Build a Startup. And it was the class that I wished I'd had before I had my startup. And so it was like a mini Y Combinator almost, where the students had to come with an idea. We made them get out into the street and sell. And at the end, we got a budget from the university to send the best 1 or 2 teams to demo days at either Stanford or Babson or Virginia. And what happened after the class was the students would say, well, you made me start a company. Now what do I do? And so I ended up basically helping them. I was doing consulting and I was doing mentorship and making contacts. And I realized I was doing everything that a fund manager did, except the important part of actually giving them money. And so I put together the plan for the fund that I wish I'd been able to meet when I was in Chile with my company, because I had met pretty much all the fund managers in Chile and many in the region in 2010, 2011. And there weren't many back then. And it was a lot of very well-meaning people. And with the exception of a few that were in Brazil for the most part, most people were just looking really locally or they didn't have much tech experience. And so they were trying to do a good job, but it just wasn't what a startup founder really wanted. And so I put together that plan that mixed the best of Silicon Valley kind of New York culture with LATAM to the stuff you needed to be successful. So contacts and knowing how to operate locally. And that led me to a Chilean family office that wanted to diversify into tech and also give back to the next generation of entrepreneurs in the region. And that was at the end of 2013. And from there, that's where the idea to start a fund starts.
I love it. There's a couple things that I think are cool there that are learning points. One is, finding that unique entry point, which I think a lot of entrepreneurs don't do, where you looked at the marketplace and you could have gone to Silicon Valley and done a tech fund in Silicon Valley after having a few little exits, but you wouldn't have been the VC in Silicon Valley. You would have been another dude in the mix. And so you kind of said, where's the unique opportunity that I could actually create an unfair advantage in the marketplace. And I think that's super smart of you.
Yeah, and I don't even know if I could have started a fund in Silicon Valley or New York, even though, because again, like you said, I would have just been one more, and there's plenty more people that have been more successful and have better backgrounds and all that would have been more likely to raise money. And I mean, there were also people that told us at the very beginning, "You're crazy. You're going to lose all your money. Come back to New York." Or I remember sitting in a big office building in Manhattan with that happening from somebody who's really successful. And so, yeah, I think that was going to a niche was really helpful.
Yeah. And then the other thing that I think is interesting that you did, which is partner up intelligently. You could have also tried to just go out there, a young kid without the gray hair that's sometimes necessary to be a fund manager, and try to scrape together some capital. But it's really hard to do if you don't have a track record, don't have experience, don't have a ton of money yourself, or didn't have a, almost household name exit. And instead you said, well, I'll partner with a family office who has some of the gray hair and some of the capital. And that gives you a little bit more cachet as opposed to just being an individual. At least that's what I'm guessing.
Yeah, and it was also for Chile. I mean, I had been in Chile now at that point for about 4 years, and I knew stuff. I spoke Spanish. I had a network, but like a guy who's been there his whole life, all plugged into the biggest businesses, had served on company boards. I would probably have gotten eaten alive without having a good local partner. So he was the perfect, and still is the perfect complement to my kind of US and Silicon Valley tech experience, with his on the ground know-how to sort of make sure we didn't get into trouble and help the companies.
100%. And then the other part that I think is interesting is, when you, at least I'm like kind of recalling the first fundraise, and when you brought the fundraise, you had to do something different than most people, which is educate people on the Latin America investment universe in tandem with what we all know, which is tech VC to some degree. And so you did a bunch of really interesting marketing things that now is normal kind of for VCs to have. But back then, it was a weird that you had like a book on traveling in Chile and what to do down south. And you had a podcast called Crossing Borders about, how to do business in Latin America, and a blog. So talk about some of the ecosystem you built to fundraise, because a lot of people listening want to know, how do I fundraise? And they attack it like this, going straight out the family offices or money and not thinking about the ecosystem.
So I think there's also a big step before that fundraise. And I've been all in on content marketing and non-traditional stuff since, I really think, my first company back in 2000 and I don't know, 6 or so, something like that. And content has always been a strategy that's worked for me. And so I wanted to double down on it and do it. But the thing, especially if this is, cash flow we're talking about, there was no cash flow for many years, right? Because the way that a fund works is that you normally are charging 2% or maybe 2.5 or 1.75 or whatever it's going to be of your capital. And our first money was just Francisco from his family office and me. And so we only had about $2 or $2.5 million to start. So if you do the math on that, we're talking, $40,000 a year to actually do something, right? And so one of the non-traditional things that we did in addition to the content was we figured out ways to either share expenses with startups we invested. We did consulting for people on the side. We did all sorts of stuff to basically be able to live on it. And so I think one of the things that, even for like big funds, I saw someone on Twitter talking about it. And I think she said, if I would have known it would have taken me 7 years to get my first big carry check, I don't know if I would have done this. It took us like about 6 for the first big carry check. So we had to be really entrepreneurial at the very beginning. And part of that being entrepreneurial led into, how do we create a following of like people who really care about Latin America or could care about Latin America. And because we couldn't do the things like, hey, let's pay $25,000 for a seat at one of these conferences, or we couldn't pay for someone to go raise money for us unless they were willing to do it 100% on spec. And at the point when we were small and we're still too small to basically get somebody who's really, really good to do that just as a percentage, because they want to raise 150 or 200 million for you and take a nice percentage rather than, 25 to 50. So we did things like we started writing content about what was happening in the region. We did a blog. I started doing a podcast called Crossing Borders, which basically, and I think you've been on twice, Cody. We basically it was for two things. One is to raise the profile of the entire ecosystem, because we needed people to understand what was happening in LATAM. And we kind of thought, the rising tide is going to lift all of us. And if I'm the one doing lots of interviews, it's likely that we'll get some money from it. And it's happened. I think we've had at least $1 million and probably more come in from LPs that have listened to the podcast and said, okay, I want to invest. But at the same time, it was me getting a chance to talk to all sorts of really smart, interesting people that would later become either referring deals to us or sending us LPs, or helping our companies. Even in one case, probably they later acquired one of our companies. So it was kind of a win-win. It was a good investment to do.
I love it. Okay, hold on one second for me here, because perfect, works great. The other thing that I think is interesting is, so typically the model goes like this for raising a fund, right? Like, make a bunch of money in your exit in startup land, use your own money. Daddy and mommy have a ton of money, use their money. You leave a firm that's pretty big, you get to take some of the LPs with you and you take their money. But it's very hard if you haven't done any of those three things to actually fundraise. And you nailed the point. I mean, I remember we talked years ago. I used to raise money for a really big fund, and when we were looking at the economics of some of the smaller funds in LATAM, I was like, God, how do you eat? And then you explained you have this, a model that I've actually seen by another company called Interplay in the US that Kevin Tung runs. I don't know if you know him. But where essentially you have services that you can provide to some of your portfolio companies. And I like this model for people that are scrappy. So if anybody's listening to this, they're kind of thinking right now, okay, I'm putting my own money to work. Maybe I want to diversify into a fund like Nate's, or maybe I want to think about putting my money alongside some other people. How do I actually make it cash flow? So before we get to the 2 and 20, talk a little bit about, you had the video production company, you had a podcast production company, and you had almost like an incubator that you used alongside your fund before you started getting some of the bigger checks and having some of the wins, which I think we should hit on too.
Yeah, so we did a bunch of non-traditional stuff that at the time, and still is for some LPs, is very controversial. So, the conventional wisdom is never operate in one of your portfolio companies. And so never go and work part-time or do something in one of the portfolio companies. And I think that's generally true. But when you are an operator and you don't have the budget to actually do something, at the very beginning, we probably only had six or eight companies we invested in. So I was able to get consulting from our top portfolio company, and I was helping them with kind of content marketing and sales because I knew how to do it. I had done it with my startup. And obviously there is legitimate conflict of interest there. So you have to disclose that, and you have to be really open about it with your investors. And luckily at that time, it was just one investor, it was my partner, Francisco. So it was very clear. I just said, hey, my salary for 5 years was $24K a year from Magma. So how can I augment that? And it was, okay, let's have a win-win. Let's make one of our portfolio companies better, and they can pay me some extra money. So that's where it started. That was kind of the beginning of it. But as we continued to build, what we found, especially in Latin America, was that companies weren't failing because of a lack of money. They were failing because their feedback loops were too slow. And in Silicon Valley or New York, you're going to get feedback loops of days or weeks. So if you go and do something and the market's going to tell you fast, or your team will tell you fast, your investors will. But in Latin America, part of it is culture, and part of it is that there just aren't that many people that have done it before, is that your feedback loops could be months or even a year. And startups die if their feedback loops are too slow. So we were getting sick of either seeing startups have feedback loops too slow, or they would go and hire consultants that just weren't any good. And so we said, well, why don't we solve kind of two problems? One is let's help the portfolio companies. And then two, let's actually like charge the money so we can build out a team. And because for the first, from 2014 until the middle to late 17, I was basically the only person that was full time. Francisco was part time, and then we would have every once in a while someone who would help us. But in order to actually bring in a team and grow to, we're now 16 or 17 people, which is a very big team for our size of fund, we had to do things like that. And that evolved into seeing the Andreessen Horowitz model, which is that they have a in-house agency. They call it the agency model, where they basically have best in class, best people that are going to help you with your startup. And I forget which one of the partners talks about it, but I think it's Martin Casado was talking about it. And he said when he had his startup, something like half of all of their leads came from the Andreessen agency model for their sales pipeline. And so he said, well, we have all these connections in LATAM. Why don't we try to replicate that? And it solves our problem of being able to charge. Andreessen obviously doesn't need to charge because they've got billions under management. So it's part of their service. But for us, we had to do it. And so we started building what we call internally Magma Infrastructure, which is our internal agency that does two things. It provides the help. So we started with things like content marketing, podcast production. We created a product called LATAM List, which is sort of like a TechCrunch for Latin America, where we can generate some income and also promote the whole ecosystem. Basically, just if now we look back on it, and the way we think about it now is kind of the Amazon model, where they find anything that's going to be a cost and try to make it a profit center. So we started doing that with all the things for our startups. And it still is controversial today. And we have to have like very clear conflict of interest rules, which are all reasonable. But you know, one LP who was very successful and an institutional in the US said, well, you're doing too much stuff. Why are you doing that? And I said, well, you know, one, we're sort of modeled after the Andreessen model, and two, we need to eat. And they said, well, you're not Andreessen, you're not obviously them. So you need to focus on just being a fund. And so we've had to do these things that for me are the right thing to do, but also support us. But it's not without controversy in the VC world.
Yeah, makes perfect sense. But now let's talk, before we get into some of the how-tos, which is what I want to focus the last part on, and giving people some actionable ideas and insights. Let's focus on some of the wins you guys have had, because Latin America is a tough market. I mean, that's the part that US investors, I think, don't realize really, is they see this LATAM and, you know, they think that it could be this big, huge ecosystem, which is shaping up to be more and more. But when you think about the number of exits in LATAM versus the US, both from a size and scope and, you know, velocity of them, it's just such a different animal. And so, you know, when you first started, you know, you had some small sort of exits and opportunities in the region, but now you've had some of the largest exits in Latin America. So why don't you hit on a couple of those, and then we can shout out some of our buds who have been big members of that.
Yeah, so when we first started in end of 2013, there was only about $500 million invested in the entire region from Mexico South, so including Brazil. And that's for a region of almost 650 million people. So less than $1 of VC per person. And we're talking like Southeast Asia has 20 billion, for example, and has about the same population. So we're talking way underinvested. But that's starting to change. So last year was about 4.5 to 5 billion. So it's grown really a lot. And we've had really good timing where we're riding this wave as more people kind of find out about it and start to invest. One of the big turning points was maybe 2 years ago, with SoftBank announcing a $5 billion fund for LATAM and starting to invest a lot more. But at the same time, you had two companies called Stone and PagSeguro, which were huge IPOs in New York, and now they're worth, you know, $50-60 billion. You had Mercado Libre recently is now 100+ billion, the most valuable company in Latin America, period. And you're starting to see these big, really venture scale returns, in addition to still private companies like, Nubank is now worth 25 billion. They've been around for 6 years or 7 years. And so we were kind of right place at right time, and now on trend. And I still think Latin America is super early in terms of where it should go. I think we'll see a lot more exits now that kind of like basically all the big US funds are looking at LATAM now. And so some of those companies that we're excited about or have done well. One's a company called Omnibank, which we were the first $50,000 check into them when it was the co-founders with basically a demo. And then we were able to follow on about 4 more times. And they ended up getting acquired by a company called Greensill Capital last year, which is, they're an SME lender, and Greensill bought them. So that was a really good return for us and our investors. Another interesting company that's probably one that will become really fairly well known in the future is a company called Kushki Pagos, which you actually introduced us to.
I know, and then didn't put money in, just gave you money in the fund. And I should have re-upped with Diego at Omnibank too.
But that they're turning into probably one of the biggest payment success stories on the Spanish-speaking side of Latin America. It wouldn't surprise me that if there'll be a unicorn at some point. Another interesting company that's not in the finance side is called Fanatis, which is now a streaming software platform. So you can watch all of Latin American soccer games streaming in the US. It's a monthly service fee. That's going to be a really big company. And another one is I believe we were the first fund to invest in a company called Albo, which is Mexico's biggest neobank, which has now been raised 100+ million on top of it. So yeah, we've done a lot of fintech in the region, some insurtech, and it's turned out well.
Yeah, the cool part I think is that you started with such small dollar amounts, so it's not intimidating. I mean, we're talking about $2.5 million for the first fund, and some of these investments being a lot of them being $50,000 to $100,000, and then having enough for follow-on funds or allowing pro rata for your investors. So let's get into some of the how now. Like, first of all, if you were to go back, or if you were to start new, with everything that you know today, what would you tell Nate at that time about raising a fund, and what do you wish you knew then that you know now?
So I would have, in terms of the mechanics of the fund, there's a ton of, I could do a whole thing on lessons learned from investing in the companies, but in terms of mechanics of the fund, yep. I think that one is the traditional way of doing a fund is 2% management fee over 10 years, and it falls off some depending on your calculation, but probably somewhere around 15% of the fund becomes fees over 10 years, more or less. Could be a little less, could be a little more. I would have put 12 or 14% of that in the first 3 or 4 years at the beginning to have a lot more money to operate on, with the understanding that either I would raise a new fund and have enough budget to be able to pay myself, or I would not be doing a fund anymore and I would be, helping the company still and working on something else. So I would have front loaded that management fee, because that would have allowed for, in my case, I didn't really need a much higher salary. It would have been nice to have, but it would have been really nice to have 1 or 2 other people 100%. Early, right? So that's one thing.
And you can legally do that in the docs, which is cool, because it's all reserves. So you take the capital if you called the capital all at the same time for your investors, as opposed to a rolling close where you call it on a continual basis. You could have just said, we're going to take 12% up front and have a 25% capital call of all your money. So I'm going to take 12.5 and save it for myself and my team, and 12.5 to invest, and then we'll call more as you go. So I think that's actually smart. And a lot of funds do that when they're smaller, but they'll only maybe take like 5% in the first year or something. So yeah, that's smart.
Yeah, so I would have probably done like 4, 4, and 4, or 5, 4, and 4 for my first 3 years. And I think that would have been a big plus. It would have made life a lot easier. I think that the other thing is we did our first entity was a Chilean entity. That was really bad. I would do a Delaware LLC or LP. That's the easiest to get started. Probably LLC if you're just getting started. Not do anything weird. Don't try to do Cayman from day one. Just do something really simple. And we started using, there's kind of two platforms that we've used. One is Assure and the other one's Carta. And the two of them make life a lot easier. And you can, for, $15,000 or dollars or so over the life of the fund, if it's a small one, right, you can just have someone else manage all that paperwork for you. And it becomes, I would have done that. I mean, we tried to save on legal stuff and accounting stuff at the beginning, and that ended up with basically 7 or 8 months of 2020 was dedicated to like fixing all of that and getting everything correct and good. So do it right the first time.
Yeah, I've seen a ton of small funds, and you're right now. So Assure is basically a platform that allows you to take in all your intake documents, and they can pay your W-2 or not your W-2s, your K-1s from it. They can do all the taxation, and it's the largest LLC provider that's out there for the fund world. So they've got a pretty nice system going, and it does make your life so much easier, because I think one of the worst parts about raising a fund is definitely fundraising, but even worse, getting people to sign the docs and sign the docs correctly. Like when you are a first-time manager, all you want them to do is sign on the dotted line, and then you have to have them do it 3 times because people are moronic and they spell, they put their name or check the wrong box. And if you don't have somebody doing that for you, you're going to pull your hair out the entire time. So I totally agree with that. I use Assure for my SPVs too.
And also for the compliance stuff. So, all sorts of learning experiences, like when you actually make money, how do you do that? How do you send money out to people? Like, what is the way to do that? When you know the numbers, but like, how do you actually physically do it? How do you make sure that you're not screwing it up? So having someone there, and also the same thing on K1s, like, you don't want to be the guy that someone gave you 25 to 50K in an early fund, and then you are the one that gives them the K1 6 months late, and they have to amend their taxes, or they're really mad at you, right? So we did all that stuff, and so it's much better. Assure is one, we use them, and then Carta also has it. Their new service has it for SPVs and for small funds. So both of them are good options.
Yeah, I haven't used Carta for that. We use Carta for all of our portfolio companies for all of their cap tables and to keep track of their offerings and all their offering docs. It's a total game changer, because the other part is, what you'll find is you want data as you get further along in a fund. So you're like, well, we invested at this cost base. We invested when they're at $1 million valuation, and we had, this percentage of investment, and then we're going to do a re-up round. But like, what did the documents say exactly 2 years ago when we invested 25K in this little tiny thing? And if you aren't maniacally organized, and also you don't have like it time-stamped and data tracked and all of that, it can get really hairy. And none of this stuff is rocket science. It's just organization and following the letter of the law. And you're absolutely right. The Assure part for a fund admin, we use a fund admin that's a different one, but from a fund admin perspective, they are responsible for the calculation to decide what are the distributions going to be for each individual investor. So that takes the liability off of us in a big way, which is one of the more, your fiduciary liability as a fund manager is important. So I think that's really good advice.
I think the other option too, if you don't want to do a full fund at the beginning, is starting with an AngelList syndicate. So if you do think you have another viewpoint and you can bring your own investors to start, they have a good deal where basically you just pay the fee, but you don't have to pay any carry to them if you're bringing the investors from your own network. And then maybe later if your syndicate gets popular, you'll get followers. But that's another potentially good option for someone who wants to get started.
Yeah, and also I think doing something like putting together an SPV of investors, a special purpose vehicle, which is just basically a fancy document that protects you legally in some ways for investing in an investment entity, but is doing an SPV and then investing in a fund like yours. So instead of sourcing individual deals on a deal by deal basis, learn by investing alongside somebody like Nate, who has a fund that you could have more access to. Because if you try to go to the big guys like Andreessen Horowitz or Sequoia, first of all, they won't take your money. And second of all, you'd have to give them way too much money in the event they even would take it, and then they won't pay you any attention. And so, but if you bring a group of investors together in an SPV, then you can have a pretty deep conversation about how do you run all this stuff under the auspices of due diligence, and then watch this other fund learn and grow, and then you can actually be fulfilled to do it. And I did that early in the beginning with you. I didn't come from VC world. I was traditional private equity and alts and ETFs and everything but and so I got to kind of see by investing alongside you. So I think that's good. Okay, what else? You also have a model that you shared with us that was cool, that basically is a not overly, the thing about models I always find is they're funny. They're like our little ego of like what we think the world could look like. And I love your model because you don't overcomplicate it and try to make this look like you're predicting, I don't know, the future rotation of the Earth. And so maybe you could kind of talk a little bit about this outcome analysis model that you have and how you use it.
Yeah, so we wanted something really simple, because at the beginning it was just kind of we would go with our gut and we would talk it over a coffee or a beer, and that was the decision. But then once we had more people on the team and also had LPs that would want to be able to check in case we lost their money or we did something wrong, right? We needed to have a paper trail to show why we were doing stuff. And in addition to that, it helped us think better. So one thing, and going back to your last question before we get into the model, of like, one thing I would do even before you're starting to invest in a fund or invest in companies is we write an investment memo for every company, and you can do something really simple. It can be 1 page, can be 2 pages, whatever. Do that. Like, you can write fantasy investment memos to yourself and don't share it with anyone, but you kind of start to figure out how to think about stuff. And then you can see 2 years later where you actually write. And if you do want to share it with people, you can share it with angel investor friends, fund friends. One of the best ways if you want to get into VC, maybe not as a manager, but just like get a job at a fund to start, one of the best ways is to show them you're doing the job already. And kind of the beginning job is you're going to be writing those memos and doing the research. So having some of that ahead of time and showing when you do want to raise a fund, hey, I have this track record. I put it through DocuSign so you can see that there's actually my signature that's timestamped on here. I didn't make it up. Like, look at it. Look at what we would have made. So that was one practice that I would wish we started from day one, or even before day one.
Idea.
And because it makes you stay honest with yourself too, right? Because I mean, there's a lot of luck in this business, right? It's there's a ton of luck. And so going back to the outcome analysis, we looked at a bunch of different people, a bunch of different funds and how they did their calculations. And there were some that were extremely complex. And then there was, we got our inspiration from the Bessemer, the Bessemer memos plus outcome analysis. And so we just kind of looked at how they were presenting it. They've got a memo page that we can put in the show notes, I think. But what we did is we said, like, what's the chances this company is going to be zero? It's going to go bankrupt. And the stats say for like a pre-seed company in the United States, so kind of PowerPoint deck and some maybe a little traction, 70% of them are going to be zeros. They're going to just be full write-off. And then your 8th company might be return something, your 9th company might be a 5 to 10, and then your 10th company, if you want to be successful, needs to be like 20, 50, 100, right? And so we go in thinking that every company should be one of those good ones, or else you wouldn't invest. But you just know that it's not going to be. And if you're thinking at seed or A, it might be a third, and a third. So we think about, like, okay, so we know that full write-off should be somewhere around 60, 70% for a pre-seed. Some amount of return should be that next 10 to 15%. And a huge exit probably is 1 to 5%, something like that.
Yep.
Really, like a big win is 10%, but like, a unicorn is under 1%. And then a 10xer or a 15xer might be 5% or 7%. So we basically make a list we spread out like what would need to happen for it to be a zero. So most of the times it's like everything fails, it's a fraud, there's founders fight, whatever it is. So we put reasons why it would go to zero. Then we put reasons why it would turn into just like a standard company, like a solid SME. And sometimes it's like, what assumptions are you making that would be wrong for it to turn into an SME? So it's like, maybe the marketing doesn't scale, or maybe their market isn't as good as you wanted, or in Latin America, a lot of times it's you can only scale in your home country and you can't get to other countries. So we'll have reasons why it becomes just a solid SME. And then it's another one is going to be like acquihire. So maybe we get a 2 or 3x, but it's not a huge exit. What would be the conditions that happens? And then all the way to the end, what's the conditions that it turns into a unicorn? And for us in Latin America, it's many times, okay, unless they're just in Mexico, it's basically like they need to become the LATAM winner for this vertical. And all of the assumptions that sit behind that for it to happen. And so that's the first one. Then we put the exit price, right? So what would it be? So is this a company like in Latin America, the neobanks, Nubank is 25 billion. They're the biggest. So what's probably the next biggest neobank of Mexico? How big could that be? Could that be 10? Could that be 15? Do we think Nubank might go to 100? So maybe the Mexico one could be 50 or 60. So we have to come up with what are those different valuations, right? And then the last piece in there is the dilution. And that's something that you forget about until you see it. One of our first investments in our fund 2 is a company that we invested I think at like a $6 million valuation, and their last raise was 200 plus. But with dilution, that first check is probably only, probably about 10 or 12x, something like that, because they've had massive dilution. And so you have to account for that and try to predict that as well. So that's how we use it. And we see kind of a weighted average at the end of what's our expected multiple, what's the expected IRR. And we can use it to sanity check what we're doing and make sure that we're not investing in stuff that's too risky or things that the market's too small or whatever.
So smart, because I think the fun part of investment memos are, and we'll link this as well, like, the famous investment memo on YouTube, right? So it's like, I see a world in which, this happens, and then YouTube does this, and then, this happens. And that part's cool, because when you're investing in tech, you're creating the future, right? That's what you're actively doing, is putting money down on the future that you want. And so you get excited. But the part that's so important that I see a lot of fund managers miss when they're early is that second part. Okay, here's what we think the future could be, but then what actually has to happen, and how do we have to make sure that we allocate money intelligently in order to get the return that we want? And that's what the best managers do, and the ones that stand the test of time. And it's not that complex. It's just not something they teach in school. So that makes a lot of sense.
Yeah, we had to. There isn't something like this, or at least that I found when we were starting. There wasn't anyone breaking down the fund economics. There wasn't that stuff. And now in the last kind of 2 years, there's now like LP Twitter and like microfund Twitter, and like there's stuff there that's out there. And I think that's a huge plus for anyone trying to do this. The other thing that I did a lot at the beginning, that I wish I didn't do a lot at the beginning, but probably like 2 to 3 years in, that I wish I did more at the beginning, was to ask experienced fund managers for questions. Yep. I've gotten responses from lots of people whose name you would recognize, who I don't know at all, by sending basically a cold email saying, this is the decision I need to make. Here's how I'm thinking about it. Here's the decision I'm going to make. Tell me that I'm wrong, basically. And you'll get really, really good people to respond to you if you do the work that way, because they just need to tell you, oh yeah, you're thinking about it the right way, or no, this is wrong, right? So like one of those things in our fund two that we did that way was I had read somewhere that the investment period of a fund should be 5 years. And so like, how long can you make new investments? And I wrote that to two guys who are very experienced fund managers. And one guy wrote back and said, no, you're crazy. It should be 2 or 3. And here's why. And we made it 3, and that was it. Right. Yeah. So there's all that sort of stuff that you just, yeah, don't be afraid to ask people.
It's such a good point. And there are a lot of questions like that. Like, for instance, how long should the investment period be? What do we do with co-invests, going forward when we can't fill the pro rata or the allotment that we have with our own investors? Like, what happens with investors that want most favored nation, right? Like, if somebody gives you 50 million bucks, but they want to get it at, 0.5% instead of 2% fees, and they want a most favored nation clause, so they basically stopped you from raising, from anybody else bigger at that level. And so how do you decide that? Now, for 50 million, that might be okay, but a lot of investors want it for 2, and when you're young, you'll take that deal and you won't realize the implications sort of later on. So what else like that? What other questions should people ask themselves as they're looking to get into this space? Or alternatively, because there are a lot of people like this, what questions should they ask fund managers also in the same vein if they want to invest?
I think good questions to ask people are, what's your biggest loss been and why? I like to ask that to employees too, not necessarily in the fund, but like, you'll see what happened and why. And sometimes it's nothing related to money, but you get a really interesting answer there, and you'll get to see why or how how people think about that, right? Because you're in a business where you should be losing 50% of the time, basically. Not necessarily losing the whole thing, but you're not getting the outcome that you want. You're getting kind of like your money back or a little bit of a profit or a write-off. And so I think that's one. Another one to look at is, especially for funds, once you get to like 20 to 30 in Latin America and probably 50 to 100 in the US, is how big is the team? And that's a really easy one where you can ask, like, okay, tell me about your team, because when you do the math, if someone has $100 million fund and they're doing 2%, that means they have a $2 million a year budget. So if they only have a 2 or 3 person team, it might be okay, but they're making probably $600,000-$700,000 salary. And you have to understand what that looks like versus, for us with kind of like 600-700,000 in revenue from our management fees across the funds, plus some of the extra income from our infrastructure business, we have 16 people. So you just do the simple math and you look at, okay, we're optimizing for the really long term. I think,
yeah, which means that, like, for people listening, that means people are asking, what are you incentive aligned with me?
Exactly.
I only make money when you give me back my ROI or my MOIC, multiple on invested capital. And I want to know that you really care about the carry, the 20% fee on winnings, and not the 2% management fee. So people will ask, what's your GP allocation? How much, Nate, did you actually put in? Is it the 1% you're supposed to put in? And the answer to that might be like, well, it's not 1%, but I'm taking this much salary, and I've taken this much salary over this many years, and I'm funding all of these different things myself out of pocket. So we're hugely carry aligned. And that's a great point.
I think the other thing is to really understand if the manager actually does have a unique vision of the world and ideally has some access. Like, why are they the right person to be doing this? Because especially now, there's so many people trying to start a fund, and it's really hard to figure out who's going to do really well and who's not. And the distributions on funds are sort of similar to investing in startups, that in VC, the top kind of 10 or 20% of funds do really, really well. I think it's like 50% either lose money or make small money, right? So you're picking, just like you're picking a startup with the manager. So you really want to understand, do they have either unique access to companies? Do they see the world a different way? Are they going to help companies in a specific way? Because if not, probably you should be just looking at one of the AngelList syndicates that is out there, where you're going to see tons and tons of deals, and you can kind of pick what you want. And I also think that you'll want to see, if it's not a first fund, if it's somebody's second fund or third fund, you'll want to get kind of like case studies, or potentially ask for, if you're writing a small check, you're not going to probably get to ask for this, but if you're writing a little bit bigger check, you want to talk to maybe one of the successful and one of the non-successful founders from there, because, and I think Fred Wilson was the one who put this originally. It's like, you want to know how the fund treats the companies that don't win, right? Because that's going to be the reputation long term, because like there's lots of companies that fail, and then you want to have that good relationship, because they're going to start something again. So I think really understanding how they treated them, how that worked, because if you're writing off a company and a company didn't work, you can maybe get insight into how the manager is going to treat you if the fund isn't doing that great, right?
Such a good point. Yeah, it's like the asshole litmus test, you know.
Mm-hmm.
And stuff can go really sideways as a fund manager, and you can decide, you know, you could decide to give the investments back to your investors at some point. You could decide to reinvest them. Like the PPM, the offering docs have a lot of leeway in them. And so if you're not the most scrupulous fund manager, and you don't treat, you know, people well, there are ways that you can do that against LPs too. Limited partners or investors. So that's a really good point. So we're getting close to time here. And the other thing, like, I guess I wanted to ask you was, you know, developing that thesis. We talked about this a long time ago. You get, I mean, I saw them because I saw your deal flow for a while there. You get like hundreds and hundreds of companies, and there's really no way to analyze them all fully. You guys do a great job of really trying to respond to all of them and make that good name for yourself. But how did you develop the thesis? And, you know, I know this is a long answer, but what would you go back and tell yourself before about just the investment thesis side?
So when we first started, it was pretty niche. We knew that for at least the first year, it was just going to be Chile, because we needed to learn. And I think this was one thing we got exactly right from the thesis, was we need to make a lot of small investments to learn as fast as we can and to build our network as fast as possible. So for us, it was much better to write. We ended up writing 30 checks. We invested in 30 companies with $2.5 million. And so we made a lot of like 50 to 100K investments. And that allowed us to meet lots and lots of entrepreneurs fast, and also learn what works and what doesn't, and start to see, I mean, we made probably every mistake that you could imagine in the first year or two, in you know, wrong types of companies, wrong types of founders, everything you could think of. And so it was way better for us to have done that with 25, 50, 75, 100K checks each, than having picked 7 companies to write $500,000 checks into, right? So it's at the very beginning, it was all about at bats for us. We wanted to see as many as possible, and so that was one that we got right. As we started to expand, we basically started meeting more entrepreneurs in Colombia and Mexico, because Chile's small and it's really far away. So when Chilean startups start to do well, they should go to either Mexico or to Colombia, potentially Brazil, if they want to be really ambitious. And so it was just saying, look, we know this is going to be a growing market. We know that macro LATAM is really broken in a lot of industries, and we can sort of see kind of shades of the future of what it's going to look like from the US and what it's going to look like from Asia. And so let's just fund really smart people that are going to attack these big problems. Because if you do that and you fix even moderately some of those problems, you're going to make companies that not only make billions, but probably impact tons of people in the region. And so stuff we got wrong, there's a lot, but I think that one was, I would have, once we got into our fund 2, where we sort of had figured out what we were doing, I would have written a little bit bigger early checks, because doing the math, if we would have just doubled every one of our early checks in fund 2, we would have made a bunch of money, because the winners of buying equity at a $5 million valuation that turned into 100, if we would have doubled that, and yes, we would have lost money on the ones that had failed, those things make, you know, a big win. So I think that was one. And then the other would be, I would say, not passing on just like really good entrepreneurs, even if the valuation was a little bit high. We passed on, and for us, it was specifically in marketplaces, because the unit economics in LATAM, when we were first starting, marketplaces were a little bit crazy. So we passed on people that was like, these people are really good, and that we should have done. So, you know, optimizing for team.
Yeah, exactly. Okay, so if people want to hear more about Magma, think about the region, hear more from you, connect with you, magmapartners.com, what's the best place for them to go?
Yeah, magmapartners.com, probably the podcast Crossing Borders, which you can find on
all podcast sites.
Yeah, all the podcast sites, or on latamlist.com. And always feel free to, you know, shoot me a message on Twitter or LinkedIn are probably the two most active. I'm just Nathan Lustig, both of those places. And we really like talking to and working with people that are trying to either make LATAM a better place or get into the market. We work with a ton of entrepreneurs and small angel investors that put small checks into the fund, just to, you know, create that relationship and help understand what's happening in the region. So we're always happy to talk to people.
Love it. Thank you so much, Nate. You're the man. And we'll link all of your variant segments below so everybody can get in contact with you.
No, thanks for having me. I appreciate it.
Dude, my pleasure.